So the next section of our syllabus is about applying. So this is where it all comes in with the spreadsheet work that you need to do, the practical application of those things that we've been looking at. So yes, you need to be able to explain the complete accounting process and all of the stages within that. And you need to be able to explain balance day adjustments and understand what's happening with all of those different things. But you also need to be able to do them in a spreadsheet kind of context as well. So there's a whole bunch of stuff here. You need to be able to record transactions in the general journal, and it's really handy here how the syllabus tells you exactly what you need to be able to do. So opening entries, purchasing and selling non-current assets, all different things here that you need to be able to do. So I recommend that you get this written down somewhere, take a copy and use this as part of your study preparation. You will be able to look at each and think, do I actually know what that means? And if I don't, then of course that will be your first step, figuring out what it involves. But then also just thinking, can I do this? Do I need to practice it more? And using this as a bit of a checklist. Not only do you need to be able to record a bunch of different transactions, but you also need to be able to calculate transactions. Some of the transactions you'll need to do are just a matter of recording them in the right way with the right accounts, either debited or credited. However, sometimes you do need to do calculations for those different things that we've been looking at with balance day adjustments and we'll go through a few different things like depreciation and provision for doubtful debts as well. And then lastly, you also need to be able to do record reversing entries as well. So we're going to have a look at a bit of an example here, and then we'll see how those different types of transactions were done in the general journal. So we've got this business called Threads, and it's a clothing business. So for July 2021, we've got a bunch of different transactions that occurred, and we need to post them to the general journal and the general ledger. So for all the accounts where GST applies, we're told here that GST is inclusive. So it's really important to take note when your instructions give you information about GST, because this does determine what you do to calculate the GST component when you're doing your transactions. So my little trick, again, that I'll mention at the end, is this idea of if it is included, you've got the I for is, and you've got the I for included, and those join together to look like an 11. So if GST is included, like it is in these transactions, then that means you divide by 11 to find the GST component. If it's not included, then you've got is again, so the 1, but you've also got not, and the O in not can stand for the 0. So you've got 1 and 0, which is 10. And so if it's not included, then you divide by 10. If GST is included, divide by 11. If it's not included, divide by 10. Okay, so we're going over the page here as well. This is just the first section of our transactions, but take a look at the different things that we've got here and think about how they relate to the syllabus that we just looked at, with what kind of things you need to be able to do in your general journal. So, for example, to begin with, what is happening on July 1? What kind of transaction would be doing in the general journal for that information? For July 2, we're purchasing furniture. Make note of how it's mentioning that we paid an additional $70 cash in delivery expenses. So sometimes it's easy to miss little details like that. We do the major thing with the purchase of the furniture, but we forget the little extra information. Also take note of inventories. When we're selling inventories, it also gives us a cost price in brackets there. So that's where you've got your cost of goods sold coming in. So it's a bit of a double entry when you've got inventories being sold, because you need to also account for the cost of goods sold of those inventories as well. The second section of this information that we've got a whole bunch of different things here, like the owner is withdrawing cash. We've got the people returning goods. We've got paying the remainder of our accounts payables. And we've also got on the 31st, you can see that a mistake was made, and so it's telling us that we need to adjust for that as well. So let's now have a look at what each of these look like in our general journal. So that first bit of information from July 1 that you would have seen is our opening entry, which is something that is specifically mentioned in the syllabus that you need to be able to do. It's really easy to forget this step, particularly when it's not as explicit as it was in this case. So in this case, on July 1, we were given that really clear information with the transaction, just along with everything else. But sometimes this kind of information may just be given to you in like a paragraph form as part of the sort of instructions for the scenario, the business scenario. So it can be easy to just skip over it and go straight to the next thing because you're forgetting that it is actually a transaction too. So the idea of the opening entry is it's showing that you've already got stuff happening in the business. So if you've got a brand new business, that is where you may not have an opening entry because maybe the business doesn't have anything yet. It hasn't bought any non-current assets or anything like that. But most of the cases that you'll be looking at, you'll have a business that's already in operation. So it's going to have some, hopefully, cash in the bank. It's going to likely have some kind of assets. So that could be inventories, it could be buildings, land, motor vehicles. So here we've got a few of those things. It can also have debts that it owes, so accounts payables, and people who owe the business money with accounts receivables as well. And then always remember that the capital is the other credit that you need to record. So you need to record all of the debits plus any credits like accounts payable. Add in all of the figures that you've been given for those accounts, and then you work out the capital account by adding together all of the debits, and then from that amount you'll be able to subtract anything that's already in the credit column, because the capital amount should bring it to balance. The debit and the credit for this first transaction here need to be the same. So adding all of your debits together, and in this case, we would subtract the 180 from that amount for accounts payable, and then whatever that figure is will end up being our capital, and that will mean that both columns are the same. And our narration for that is just opening entry. Next up, we've got the purchase of a non-current asset, which is another thing that you need to be able to do. In this case, we're purchasing on credit. So whenever you've got a transaction, the first thing that you should be doing is thinking, what's happening here? What accounts are involved here? So the non-current asset that we're purchasing is furniture. So this is going to involve the furniture account. How are we paying? Is it cash or credit? Here we know that it's credit, so it must be accounts payable. And is there GST? Yes, there is, because GST is a goods and services tax. So is furniture a good? Then it is, yes. So GST will apply. GST doesn't apply on some things, like wages, for example, and drawings. But a lot of the things that you'll be looking at, it does apply to. So if you're not really sure about GST and what it applies to, try and think to yourself about the idea of goods and services. Is what I'm paying for here a good or a service? And if it is, then it's likely to have GST attached to it. Sometimes you'll be given specific information about whether GST applies. So also pay attention to that, because it can be easy to just skip over. And if you really don't feel confident with GST, I suggest making that part of your study for your external exam and any other assessment that you're doing in accounting. That is something that's really handy to have the understanding of GST and what it applies to and why as well. So we've got purchased furniture on credit. Furniture is the asset. An asset by nature is a debit, and we're getting furniture. That account is increasing, so it must be debited as well, because that debit account, that asset, is increasing. And then accounts payable is our total amounts with how much we owe. The GST is attached to the furniture, and so you can see that the accounts payable is that liability. It's also going up. A liability is credit by nature, so it is credited because the account's going up. So think about it as when you're buying something like this, the accounts payable figure will be the full amount. In this case, it costs $500, and then the other two accounts will make that balance. So in this case, we divide the 500 by 11 to get the GST, and then whatever is left over within that 500 amount, 454 in this case, is that remainder that we put against the furniture account. I also mentioned here about taking note of that additional expense for the purchase of the non-current asset. We were told that we had to pay extra for the delivery of furniture, and this was going to be paid by cash. So in this case, instead of accounts payable, we've got cash at bank for $70. And again, that idea of furniture and GST, because that is what is involved in this transaction. I also mentioned about selling inventories. So paying attention to the cost price that you're provided as well. So here we've got we're selling with cash. So it's a cash at bank that's going up, not accounts receivable. So we're selling $166 by cash, and then this is a sale. So we're using our sales revenue account. Sales is revenues, and sales are a credit by nature. It's going up, so you credit that account. So that's that process that I would always recommend going through. Think about, to begin with, what accounts are involved. Once you've figured that out, think, what is the nature of each of these accounts? Is it a debit or a credit? So you'll think asset, liability, expense, or revenue, and then that will tell you whether it's a credit or a debit by nature. And then you can think about what is actually happening here. What's going up? What's going down? Am I getting money? Am I losing money? Am I gaining a sale, or am I paying for something? Thinking about what is actually happening, what is going down or up as a result, and then how that impacts those different accounts that you've figured out are involved in the transaction. So you've got your cash sale of those inventories, and then as a separate transaction, we've also got our cost of goods sold. Now, this doesn't involve GST. We've already got our GST for sales in the section above. All the cost of goods sold is whatever the cost price is that we've been given, in this case, $78. Cost of goods sold is going up, and inventories are going down, because in that previous transaction, we're showing that we're gaining cash, and that we're gaining sales, but we haven't yet shown that we're actually losing inventories as a result of that sale. So yes, we're getting $166 for the sale, but part of that was the cost of needing to provide the inventories that customer bought. So that's where the cost of goods sold is reflecting the fact that we've lost an asset in order to gain that sale. We've also got credit sale of inventories as well. So the same idea, except it just involves the accounts receivable account in the first section there, instead of cash at bank, and the rest is all the same. The fact that it's credit doesn't change the cost of goods sold transaction at the end there. It only changes that first account. Instead of cash at bank, we've got accounts receivable. Now, not only are you going to need to be able to do the selling of inventories, but also the purchase of inventories too. So here we've got a credit purchase of inventories. So this means that we're getting more inventories. So that asset account is going up, and that's why it is a debit there. And then we are paying Chapman Textiles in this case. So we've got that accounts payable account that's also going up. And in this case, cost of goods sold isn't relevant because we're not selling it. Cost of goods sold is, of course, only relevant when it's that selling transaction, not when you're purchasing inventories. On the 6th, we've got our paying accounts in full. So when you owe money, like we did here, you do the opposite of what you can see in that purchase of inventories. The purchase of inventories, the accounts payable is a liability account, credit by nature, that's going up. So it is credited. Whereas on the 6th here, we are paying off our accounts payable. So that liability account is going down. So we do the opposite of what the nature is. The nature is a credit. And if it's a credit by nature, you go to increase it, you credit it again. And if it's going down, then you are going to debit that, the opposite of the nature. So here, cash at bank is what is going down because we're paying for it, and that is that other account there. We've got drawings of inventories with our inventories going down. So inventories usually don't attract GST. So this may be a case where GST isn't actually supposed to be there. And then on the 7th, we've got obtaining finance. So this means that you are getting a bank loan. You're getting finance. So your cash at bank in this case is going up because you're getting extra money. And then the loan, which is the liability, is also going up. So that's credited there. We've got a purchase return here. So not only do you need to be able to do credit and cash purchases, but also any returns that you have as well. So we've got this accounts payable going down, and because we're returning inventories to Chapman Textiles, and so our accounts payable, what we owe them, is going down. The inventories is also going down because we would be returning that purchase to them. We've got the cash sales return as well. So we have the sales returns dedicated account here. The cash at bank is going down because it's a cash sales return, not a credit one. And then here the inventories are going up because the customer is returning those inventories to us. and the cost of goods sold is going down. So that's the opposite of what the purchase transaction usually looks like. Receipt of accounts receivable. So when someone is paying off their account, their credit account with us, that just involves the two accounts, cash at bank going up and accounts receivable going down. And this is the correct way to do drawings. All you've got is your drawings account and your cash at bank account, drawings of cash in this case. So the drawings account, a trick that I use to remember that it's a debit by nature is it starts with DR, which is of course our little acronym for debit. So when drawings is going up, we debit that account. Cash at bank is going down because we're removing cash from the business for personal use. Selling a non-current asset. So instead of having our asset account increasing, in this case, the asset account, land, is decreasing because we are getting rid of it, and accounts receivable is going up because the business that has purchased that land from us now owes us money for that. We're paying our accounts payable for Chapman Textiles, so cash at bank is going down. That liability account, accounts payable, is going down as well. And then finally, we've got another revenue. So, so the syllabus also mentions you just need to be able to do everyday revenues and expenses. So in this case, we've got rent revenue. Again, cash at bank is going up. It must be the rent revenue account because we're receiving rent, and there's GST on that as well. And then there's another example of one, except this time it's an expense. We've got advertising, GST, cash at bank. And then commission is another possible revenue that you could have. So if you are a real estate agent, for example, then you're going to have likely commission revenue on the different properties that you sell. A cash refund for purchase returns is happening here on the 26th. So this means that we are getting money because we've returned something that we've purchased, and we have been issued with this cash refund for whatever it is that we've returned. So the cash at bank is going up. We've returned inventory, so that asset account is going down, and we're reversing that GST on that amount that we're getting back to reflect the fact that that's happening. Other expenses. So you can see on the 28th here, something to note is that we've joined all of these together. So you could be doing a transaction for each of these individually: electricity and cash at bank, and GST, rates, cash at bank and GST, etc. Except in this case, since they're all happening on the same date, we're actually able to join them together. So you are adding together all of those accounts to get the overall cash at bank. Then you're dividing by your 11 to get GST, and you've got all of your individual amounts for those different accounts as well. You've got your wages here. Like I mentioned earlier, wages doesn't attract GST, so that's a really simple transaction. And finally, we've got a correction of errors entry. So there was an error made on the 22nd of July, and so we are accounting for that by just changing it to reflect what actually happened. In this case, advertising is going up, cash at bank is going down. So next up, you also need to be able to do your ledger. So all of those accounts that we just dealt with in the general journal, you need to be able to post them to your general ledger. And so there's a couple of different formats you can use for your ledger. Um, you can have your side-by-side kind of format, which we call account form. You can also have your narrative form. When you think of a narrative, it's written um, from left to right all the way down, and that's the kind of style that we're going for in this example here. So it is a good thing to know how to do both ways. That's important because you don't know what will be on your exam in terms of whether you'll be given a specific way of formatting the the things that you need to do. So we have all of our different accounts for our ledger, um, and then we have everything that happens within that. So make sure when you think about this, it can be easy to get a little bit muddled with your ledger. So for the sales account, for example, you are writing down whatever the opposite accounts are. So if you've got sales, then your cash at bank on July 2 is going up. So that is the other account that's involved in that transaction. That's the account that you put in the particulars column here. However, while you are putting that opposite account in the particulars column, you don't put the opposites for the actual amounts of money. Whatever amount was next to sales in the general journal is the amount that you put. So you put the opposite account for the particulars, but the account that's next to what you're looking at, in this case, sales is what we're looking at. That is what you put in either the debit or credit column, whatever one is relevant. So if we go to July 2nd to have a look, so we've got our, here it is here, the second one from the top. So we've got sales. That is what we're looking at in the ledger. And the opposite account to sales is cash at bank. However, we aren't taking the opposite amount of money. We aren't taking the amount of money that's next to cash at bank, the 166, because what we're looking at in the ledger, what the section is dedicated to, is the sales account. So we've then put $150.91 because that is the amount that's next to the sales account. So it's that same process for all of your different ledger accounts. And something else to note that I will mention is it can be tricky when you can easily forget the opening balance as well. So just like you've got an opening entry for your general journal, sometimes you've got to have your opening balance for accounts here. So that's not relevant in any of these cases, but we will see that shortly. So sales returns, we've got our amount. So making sure that you've got your amounts in the debit or credit column correctly. So again, we do the opposite for the particulars, but everything else is just from the sales. So not only the amount that was next to sales, but also the nature of that. The sales that we just saw in that transaction were in the credit column for $150.91, and that's exactly what we've done here. We've got our cost of goods sold as well. You can see how something different happened on the 12th because we had a reversal of the regular cost of goods sold as well. We've got all of our different expense accounts here. And here is an example of what we were saying before with the balance. So for cash at bank, you've got your balance to begin with, because we're not just starting from zero for the bank. We're starting from $2,700. That will usually be provided in the information that you're given somewhere in the question. So take note of that and add that in. All you need to put is balance as the description, and then put it just as the debit, or if it's a credit as well, put that nature there as well. And then following that, you can add all of your additional transactions in the relevant columns. And you can see that we've got the same thing for the accounts receivable. We had that existing balance at the start of the period. That was in our opening entry for our general journal, $120 for L. Hawkins. And then we actually paid that amount off. So we did a credit to that debit of 120, and we end the period with nil for that account. Some accounts you can see don't have the nil, and that just is indicating that we haven't received the money for that yet. These are accounts receivable, so it's about receiving the money. We have for H. Winters and L. Hawkins, but we haven't for the others. And then this is then reflected in our trial balance as well. So you can see again, we've got the balance here for inventories too. And the same thing can happen for accounts payable. If we've paid off an accounts payable account, like we did for Chapman Textiles, then we end the period with a zero balance for that account. And like I mentioned, this is reflected in the trial balance, which we'll be looking at next. And then lastly, we've got our GST clearing, loan, capital, and drawings. So making sure that you put in everything that's included in that opening entry. So capital doesn't appear anywhere else except for that opening entry, but it still has to be included in the record. So here you can see we've got those, for example, those accounts payables. We said that Chapman Textiles had a nil balance because we'd paid that off, and hence that's why we don't see that appear in this trial balance, because it has a nil balance, so there's no point in including it. Same thing for L. Hawkins for accounts receivable. That account doesn't appear here because it has a zero balance. So creating a trial balance is useful because it confirms that you've completed the general journal either correctly or incorrectly, and the ledger as well. You could have errors or one error in the general journal, or it could be in the general ledger, or it could be both. So the sum of the debit column should be identical to the sum of the credit column. You can see at the end there, we've got our amounts all added up, and both of them add up to the same figure. Something else to note is making sure that you've only got your 2 decimal places, because you need to have that consistency with cents. Dollars and cents, there's only ever 2 decimal places. So for example, here for cost of goods sold, we've got $359 in the debit column, but we don't have the cents. So yes, it may be just 0 cents, but it is good to have that consistency with everything. So putting the decimal with the 2 zeros after that is going to allow everything to be uniform in the way that it is recorded. So the trial balance is just getting all of those accounts that you've dealt with in the ledger with their ending balances, and then putting that in the relevant column, and then doing that sum at the end to see whether it balances. And if it doesn't, you go back to what you've done previously with your general journal and ledger, and you see if you can identify the mistake. Sometimes it's good to look at those two amounts that you get at the end. If they're not identical, subtract the smaller one from the larger one and see what the difference is. You may be out by a really particular amount, and based on that amount, you may be able to look and see, oh, I missed this transaction that value. It could be that exact value, and that makes it easy. It could be that you've put something in the wrong column for GST or something, and you might be able to identify that more easily if you know that exact amount that you're out by.